And go.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker.
Now, the question is, can you guys hear that? Can you guys hear that thing, the speech? Yeah? Oh, that's my new thing then. Let's try it again.
Consult a licensed broker, a registered investment advisor before placing any trades. All securities and orders discussed, tracked, and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of the respective officers. Personnel, representatives, agents, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risk. Visit the OCC website www.optionsclearing.com to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you to the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on a specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right. Hey, that was great. I love that. All right. There you go. All done and ready to start. Let's see what's going on. So the charts. So on the whole, we're popping, but you know, look, we're popping back to the same stupid highs that we hit every time. That's why somebody said, well, you know, what are your short lines? I'm like, the short lines are the same short lines we had all week. You know, nothing really is changing. The dollar is where the dollar has been at its highs. Oil topped out at 50, which is what we thought oil would do. 49.45, it got rejected. Natural gas getting, you know, got up to $3. That's fine. The Nikkei went up nice. Now the Nikkei is 16.9. 16.9 is generally where we start liking to short the Nikkei. It really doesn't like going to 17. All right, and I called these out this morning. We were a little bit lower, I think, this morning when I called it out. But the bottom line is I still like all these shorts. Gold still plunging. Wow, very sad for gold. Gold's way down, getting towards 1250. Should bounce to 1250, and silver should bounce to 1750. Those could be interesting plays. We might keep an eye on them for later. Personally, we picked up $1,700 on two coffee contracts this morning, and now it's pulling back a bit. And I'm down, though, how much is that? $8.90. I'm down $8.90 on 12 now. I have 12 oil shorts. So now for the day, though, at some point today, I guess when the day opened, whenever that was, I was up a lot, and so for the day, I took a huge hit. But that's okay, because my goal was to have a very large position. So this is from the open. So the overall position, I keep scaling into it, and my goal was to have a lot of shorts at a high strike. I've accomplished that goal. I haven't made any money yet. But I have got what I wanted, which was a lot of shorts I'm at 49.68 on this set. So I have 12 shorts at 49.68 on the average, and we're at 49.75. So, you know, a little loss at the moment, but this was my goal. Starting off here at 47.50 or whenever, or 48, we started shorting here. I kept adding, taking off, whatever. And now I've got what I wanted. I've got a nice high strike, and I'm hopefully going to be able to hold it on for a little bit and take a nice ride down with it. We shall see what happens. Meanwhile, these red lines are kind of important. So let's take a look at, we don't need coffee anymore, so let's get off coffee. That's from last week's webinar, good trade. We got the S&P, we need the NASDAQ. Should I ignore oil? I'm scared to ignore oil. I guess I will. And here's Mr. Dow. So we got this is resistance 1. Resistance 1 is over here. Resistance 1, resistance 1. So everybody's at resistance 1 except the Russell, which popped over. But we know the Russell is flaky, so, let's ignore that and worry about what these three guys are doing. And so we're going to assume that the S&P doesn't get over this line. We're going to assume the NASDAQ stays under this line, which is like 85, and we're going to assume that the Dow goes under. So when 2 and 3 of these break, well, the S&P is already broken. So, if they start turning down more than they are now, we're going to use the 00 line and the 55 line, let's say, just to be sure that they're going down. Then we'll grab a short on these and see what's going on. I think it might not be. Look, it's tricky right now, and obviously there's no conviction to this. We're just looking for a normal pullback. We've had it day after day. I mean, look at this disaster here. Things start off with a bang and they fade out into the close. So we'll see if this continues as a trend. We got these longer term charts, not you on the indexes, and we look at the hourlies. So, you have, although this is obviously later than most of the selling has started. We've had afternoon selling. Here's a huge run-up, though, but that was because of the rumor of the Deutsche Bank thing. Afternoon selling, this one went up in the afternoon. This one went, I would say, up in the afternoon, basically. This one, that was all day selling. This one's all day selling. Boy, when there is selling, you certainly know about it. All right, and if we zoom back to the bigger picture, well, let's not use the Dow. We zoom back to a bigger picture, we're nowhere. This is nothing. That's the funny thing about this. It all looks so dramatic. You've always got to change your perspective because it all looks so dramatic, but when you just move out to a daily view and you're like, oh, it's just this. All it is this little consolidation thing where we're doing a little triangle. Look, it's just basically still a triangle squeezy thingy, but I wish I could draw on this thing. Well, let's go to the hourly, see if I can see it. No, so you kind of lose it on the hourly. All right, well, sorry. So, coming along the bottom, though, right, going up here and going from the top down here, you can see we're kind of doing the triangle squeezy thingy and falling out the bottom of the tip of the triangle. We talked about this last week. Remember I said we're doing a triangle squeezy thingy and something dramatic is going to happen? Well, so far we're breaking down, not up. So you got to keep an eye on that. And the line is basically 2155. So under the 2155 line, the tip of the triangle, it's a problem. That is not a good resolution of a triangle squeezy pattern. And the Dow, now let's see if we can confirm it. The Dow also, obviously, in the lower part of the triangle. The NASDAQ, now the NASDAQ's looking good. The NASDAQ, but their triangle is higher, so they're really only in the tip of their triangle because the NASDAQ you draw up along here, and from here to here. So really the NASDAQ hasn't resolved theirs yet. The Russell, crazy Russell, but also the crazy Russell, though. Here's your little triangle right about here, and I would say they're above it. You have to use the 1250 line for the Russell. So there's no major determinations being made here. The Nikkei, this is a very good resistance line, so obviously this is a great one to play, actually, but then you got to watch out for the strong dollar. All right, so I think that dollar's going to 100. I think that the Fed tightening is inevitable. You've got the central, you've even got the ECB talking about cutting down on the easing because it's just out of control and it's not working. Bonds still going down the toilet, which is something else we bet on with our TLT short. So we'll see what happens. Okay, lots of people said yeah and everything, but nothing else. Okay, great. No questions, so we'll just barrel along. What was I going to talk about, though? I had something important to talk about. Oh, I remember, yeah. So we're having trouble finding good stocks. The girl on TV asked me that on Monday, and she said, well, she goes, so what are you buying? And I thought about it, I'm like, well, you know what? On the whole, we have bought some things. In fact, let's take a quick look. So the top trades, right? That's if you want to see what we've been buying, they look at top trades and say, what have we been buying lately? So going back August 22nd, and let's go back a little further. I mean, these are the top trades. These are the ones I thought were like the best ones each week. So let's say going back to see July, then we didn't buy anything at all. I really did not like the market after July. And we went all the way to August before I liked something else. So what do we buy here? We bought, let's actually go into it. I'll show you. So what do? We bought Infineon, whatever they're called. Now this is August 3rd. So basically right here we bought these guys, and they're up a little, and we just sold the puts because we wanted to keep an eye on them. So that's a winner. Okay, forget that. So I'm trying to find examples of how things aren't working, so that didn't help. All right, August, here we go. We picked up DBA. It started off well. They popped, and then they went back down, and now they're coming back. I like DBA, and it's a 2018. I'm not worried about it. But, we're looking for inflation, not happening yet, of course. Skechers, I like Skechers too. And what did we do here? Here all we did was sold the 25 puts for $5.50. So we're basically calling a floor at $20. We didn't know when this was going to stop. This is like here when it's really crashing. So we're basically right back to where we were. We're not 4 bits, then it went back down, now it's over here. But we're just saying we think it's going to be over $20. And then again, it's a short put. Probably this trade is negative at the moment. I'm sorry, so it's a type of trade. So it's a biotech play that Farm Boy liked. It's a agriculture play. It's a beaten down shoe company that we like. So an inflation play, then this is a retail recovery play. Kate's another retail recovery play, but let me get to the actual things. All right. So SunPower, we think that's a cyclical problem for them that they'll recover. UNG, obviously natural gas we love anyway, and Kate is another beaten down retailer. So Kate, look what happened to Kate. They went like that, and we said, we got to buy those. Now, if we were buying things for like a day, we'd be a genius every time, but we were buying them for the long term. So we're good on this one. It's just a matter of saying that we called a floor here. We took the 15-20 spread, which is 15-20. Wow, this is going to be a great trade. How much is this thing going to make? For 5,000. All right, so 5,400. A 54.50 gain on 450 cash. That's pretty good. We didn't put that in the portfolio? Oh, yeah. It's in the OOP. Okay, good. I feel better about that. I don't remember it being in the OOP. Though I have to get to enter it. I'd be mad if it's not here. Kate. Oh, there it is. Okay, we did put it in. Somehow it slipped my mind. Shoot, where am I? Top trades. All right, SunPower, they came down. We decided that was cheap enough. We made a play on them, and we took the 8-13 spread. So here's 8, obviously. We took it right here, and we're playing up to 13. Again, not going anywhere, but not worried. All right, well, these are not good examples. I was looking for examples of trades that aren't working. Anyway, I really had in my head these weren't going well. UNG, always a great thing. UNG came down to here. We love it when it's below 8, and we bought it, and it's going up, of course. Don't worry, I find one that didn't work. All right, back to the new ones. And of course, when you get to when you're up to August, oh God, when you're up to August 22nd, you didn't give it enough time to work. But of course, we picked Apple over here. Now it's up here, so we'll skip that one. IMAX, yes. Well, a little bit lower. So this is also August 22nd. We like that. We like IMAX. We thought 30 might hold. It hasn't yet, but we think this is a good price for IMAX. God, FTR. Okay, good. Finding something that's not working. So Frontier got really, really out of favor. We like Frontier when it gets down around $4. So we took it. We bought 4,000 at $468. This was in the long-term portfolio. We added it. We sold the 450 calls. So we weren't expecting much growth. We bought it at 468, and we sold the 450 calls. So we're basically saying we don't think this thing's going anywhere for a whole year. We just want the dividend. That's basically what this trade is. And then we sold the $4 puts because we said if it does get cheaper, we will buy more because these guys pay a great dividend. And long term, we like to own them. Long term, we like to own them. So even if we get assigned, we'll have 8,000 shares at $4 is like $24,000 worth. So not even a big allocation. Joe, coffee, of course, we like. Made a call on that. Oh, this one's August 31st. So right about here. And it's up a bit. I'm sorry, I'm not making my point at all. I was really looking for much worse trades. Ericsson, also back where we got in, and Teva. Teva, well, yeah, Teva just is getting killed. But that's specific to that stock. So I'm sorry. So I guess I was wrong when the girl asked me on TV. She said, "So what are you buying?" And I said, "Well, frankly, we're just trying to find things that pay a dividend, and we're trying to find some select beaten down stocks that we hopefully will turn around." And I thought they weren't working, but they are working. So anyway, so we'll continue to do what we've been doing since it seems to be working. I've completely blown any point I was trying to make. I'm sorry about that. Are you still bullish on Taser? Yeah, of course we're still bullish on Taser. In fact, yeah, you got a good opportunity on Taser because, oh, hang on, let me get this thing fixed. So top trades, you've been useless to me. I really had it in my head those were not doing well. That I want to get to next. Okay. And the question was Taser. T-A-S-R. Doesn't exist. Probably the D is throwing them off. See, now, if we had better AI, it would know that. All right, now, Taser. You know, I say to people all the time, I'm like, look, the stock doubled in a year. I don't want to buy a stock that doubled in a year. So therefore, if I own a stock that doubles in a year, I shouldn't be holding it either, right? Things don't go up 100% a year. They really don't. It's not normal. I know some stocks have done it and do it a couple of times in a row, but it's not normal. Making 100% in a year is fantastic money, and you've got to take it when it comes. I imagine we still have Taser somewhere. Let's see. Oh, yeah, we still have it in the options opportunity portfolio. Now, we have it because we have the 13-20 spread, and it's still at 23. So there's no, we thought it would pull back. We just don't think it'll pull back that much. And if it does pull back that much, we only have, we have 20 spreads. We'll be happy to get some more because it was working out so well. Realistically, I think 20 is a good floor for them. What happened is they lost a camera contract to supply New York police. There's a 200 DMA over there. That should hold. They lost it. See, it's rising. So when it's rising, it's got a better chance of holding. It's stronger when it's rising, weaker when it's falling. So they had a pretty good chance to get this contract in New York, but the thing is, the other guys came in and they underbid them by such an amount that there's no way to make money. And the difference with Taser, unlike the, what's his name, who got the contract, the difference with Taser is they have other people who want to buy their cameras at profitable prices. When you're trying to make a name for yourself, you'll take a loss to fill a big order so you can say, we supply the New York City Police Department, they chose us. That does sound impressive to like everybody else in the country. It's like, oh, the New York City Police Department, blah, blah, blah. Now, come back a year later and ask the police if they're happy that they chose them. That's going to be a whole different thing. Because there's a whole issue with this kind of work where the chain of The chain of custody on the videos has to be established, and all the things have to be perfectly secure. You know, if these guys don't do everything perfectly, the way Taser has learned how to do over the years, then what will happen is these camera things will get thrown out as evidence and won't be usable in court and blah, 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 and the whole thing will be a waste. I don't know that that's what they're doing. Maybe they came out with a great product. Who knows? But the bottom line is, though, the price they quoted was something in which Taser is like, screw that, it's not worth it. It'll take our time. It takes our resources. We still have to make the equipment. It doesn't, you know, just because you sell it cheaply doesn't mean it's cheaper to make. So it wasn't worth the time and effort they were going to put in to fulfill this order. So Taser walked away from it. So they won the contract by default because Taser didn't even put in another bid. But you said, okay, fine, bye. But it was taken obviously very badly, right? It went from 29 down to 23, which is really silly, okay? It's not even, it would have been nice to get the order, but it really wouldn't have made a break in their year. Made a break in their year. So, yes, I like Taser. Yes, I like them here-ish. They're not going to go down much more. If you want to initiate, see, when something's going down like this, I want to take advantage of the falling price. And what that does is, because they're falling, why? I don't get that. It must be the way I hit the S. Because why did that happen twice? So the volatility, the implied volatility of Taser increases because they took a sharp fall, right? So they took a sharp fall. That means that the prices for the puts are jacked up long term. So right now you can sell this $20 put for $285. Let me copy the thingy there. And we're going to go to the screen. It doesn't look right. You go to that screen. There you go. And let's take a long-term view of this thing. Okay. So this is it's not a great price for the puts. It's $250, so I'm not that excited yet. I want to see something more like up here. I want to see like $3 for these puts. Yeah, but, you know, you want to look at like the history of the pricing of these options sometimes to see if you're getting a really good price. It was $180, now it's $250. That's a nice improvement, but frankly, it's not that fantastic. So I don't think, given that it's 2018, I'm not that thrilled to do that trade. But that's what I'm going to be looking at. If you want to initiate a Taser trade, that's pretty much what I would start with, is looking to find a put to sell and targeting. I think really for the extra 50 cents, if I sell that for $250, I'd rather sell this guy for like $175 because he's $3 lower in price. So my net here would be like 15, whereas my net here is 18, which is a big difference when you're under 20, right? It's more than a 10% difference. So I think I'd probably want to sell the 17 puts for something like at least $175, maybe $2. Other than that, though, I mean, it's, you know, yeah, I like Taser, but I just would rather wait because I'm not that confident in the overall market that it's going to be a good price. But I do like Taser. There's no question about that. I just don't like the pricing right now. Sorry, I forgot to mute the mics here.
You are now muted.
Now you guys can make noise. And PSO, didn't PSO just pop back up? Or was that a one-day thing? PSO, we like the dividends, and they pop back up. So I have no I don't know what you expect me to say when you write PSO question mark. We like PSO though. It's a good stock. It's a solid company. They're just hitting a rough patch. They're reorganizing, but that's why they're on sale. I don't know. I mean, this is when you buy a stock when it's on sale, right? You don't buy a stock when it's not on sale. So if we go to the long-term portfolio where we added PSO. Holy crap, up 125%. I think it's like 5% better than last week. PSO. Oh, here's Pearson. So on 6/2, we bought them at $12.25. They're lower now. So what did we see? We saw on 6/2, June. Here we are. So over here, we liked them, and we bought them at $12 about. They crashed, they went up, then they went down, went up a little bit, now they crashed again, so now they're at 10. But again, we did a fairly conservative sale. We sold the 1250 puts and calls. We weren't expecting to go higher, and they're short-term trades. But you see what we did there? We knocked off $2 or $2.25, so basically we paid net 10 for Pearson. So it's really right where we expected it to be. Dividend-wise, let's see what dividends we collected. We got a dividend of 24 cents a share so far. Is that it? 4,000, Yeah, only the 24-cent dividend came in so far. But that's what we're in this for. We're not in it to make money. I don't really care I don't care if Pearson is $10 or $12. If it gets to $8, I get a little concerned. But if it's 10 or 12 or 14, it doesn't make any difference to me. I just want my dividends. I have no intention of selling this stock. It's like your home, right? On any given day, when you wake up in your home, you don't care if it's $400,000 or $500,000 or $600,000. It really doesn't make a difference what the price of your home is on any given day, unless you're planning on selling it. And for these dividend stocks, if I have no plan to sell it, all I care about is it's reasonably in a range that will allow me to sell more puts and calls down the road. And as long as I can keep selling puts and calls and continue to lower my basis on the stock, that's all I want. And again, this is in the long-term portfolio. Well, now, the long-term portfolio is now an over $1 million portfolio. So technically, we have $2 million in buying power. If you divide that by 50, we have $40,000 allocation blocks, basically. And that's if we have 50 positions. I don't really want to have 50 positions, but just to be on the safe side. So let's say we have 50 allocation blocks of $40,000 each. So this position is only a $12,000 position. Even if it's assigned to us and we get another 1,000 shares, it's only going to be assigned at net 10. That'll be 25. I mean, it'll only be 25,000. We're still only using like half of an allocation block. So so because we're scaling in, we have a very small position at the moment that we're not worried about at all. And frankly, I would rather if they went to 8 and we could double down. That would make me happier than if they come back to 12 and I only have 1,000 shares. You know, when you're a long-term investor, you have a different way of looking at things than a short-term investor. I don't necessarily want all my stocks to run up the second I buy them. You know, like Canadian Bank here, we only bought 300 shares. We never got around to buying more. We should have bought a bigger amount. Armor, I don't even know what we're doing with this one. We only have 400 shares of Armor. And they're one of the best REITs. The funny thing about them is they're holding up better than all the other REITs. They're doing great. Our pals at Canadian, we got a bunch, but that's just in share count. But it's still only 10,000, you know, $1.50 shares is $15,000. It's not a big deal. You know, Starwood, we have a good amount. We got a realistic amount of Starwood. R.L. Donnelley, we have an okay amount. Oh, and this I have to do the split. Oh, what a nightmare. They did a split. That was going to be such an hassle to enter all the stuff that happened. And here's Pearson. But we're in all these guys for the dividends, but they pay so much money. Starwood paid us, let's see, $480 plus, I'm just going to look at the quarterlies, $480, $520, there's $1,000. Pearson, $238, so let's say $1,250. NRS, $400. What are we up to there? Is $1,650, right? So maybe it doesn't pay a dividend. Here's Frontier, $420 from Frontier, very nice. That's like it's got to be $2,000 by now, right? Ford pays $300, a little over $2,000. Canadian pays $275, so let's call that $12,250. Chimera pays a huge dividend, $480, so now we're up to almost $3,000. Let's call this $12,700. Carlisle probably didn't pay a dividend yet, it was too new. On Armor, they're $88, but they pay it every month, so that's $240. So we're at least $3,000 a quarter. All right, so just these 11 stocks are paying us $3,000 a quarter, $12,000 a year in dividends. That's what we own them for. That's a nice chunk of change. On our original $500,000 we started this portfolio with, that's 2.5% of the whole $500,000, and the margin on this commitment is very low because we own the stock. When you do it like this, what we call a buy right, when you buy the stock, write the puts and calls, right? You have actually a very low dividend because there's no dividend at all to this, and your ownership of the stock, assuming you don't have a whatchamacallit account, an IRA, but your ownership of the stock in an ordinary account offsets your promise to buy more stock, right? Because you own the stock. You cannot lose money being called away. So there's no negative penalty to selling the covered calls, right? But that doesn't diminish the fact that you own the stock. So you still own the stock, you get a 2x credit on the stock, that offsets the short money on the call. So in ordinary accounts, these things have practically zero margin. And as I said, the allocation blocks for most of them, there's 11 of them, and we're all at about a $20,000 allocation block. So $220,000 worth of margin laid out on these stocks is generating $12,000 a year. So it's about 6% back on margin on these things. It's really good. And $220,000 worth of stocks means we're not using $220 in margin. Like I said, we're probably using $50,000, $60,000 in margin, $100,000 the most in margin. So yes, we will make some money from the appreciation of the stock. Mostly what we do though is because we buy the stock, like we bought Armor for 22. We sold, in this case, we sold the 19 calls and the 18 puts. And we sold those so we expected Armor. We bought Armor. We expected it to be lower we expected it to be lower in October than it was when we bought it back in July. It's actually doing better than we thought. But we sold these for $2 basically, so we paid $20.72, and we're going to roll these, of course, and we'll see where we end up. But you notice so that means that between those July and October, I'm sorry, this is we've sold these multiple times. So this is not even the first sale. But we keep collecting $2 here and $2 there. We're knocking off 10% of the price every time. Carlisle we just bought, right? Bought Carlisle for $15.60. It's still $15.60. We sold the $15 puts and calls for $2.60. So that's $13. We paid net $13 for this thing. And that's only sold March hits. Only March. So it's 6 months away. But if every 6 months we can knock off 10, 20% of the stock's price, or the stock's net cost to us, plus we're collecting the dividends at 12%, it snowballs over time to become a tremendous amount of money. We don't need to go for a big win. We go to protect ourselves. And generally, not this guy, but generally it is a sea of green. All these plus. These are all making money. Every single little position here is making money. That's in addition to those dividends. This is a fantastic way, a really mellow, nice, safe way to build up a long-term portfolio, but it's a different attitude than being a short-term investor. So on CG, do you plan on buying back the calls at expiration? Absolutely. Okay, let's take a look at CG. So here's Carlisle. We sold the $15 calls and the 15 puts. Well, it's at $15.60. So the net, now remember, we sold these for $2.60. The net right now, if it expired today, is 60 cents. Right? Because the 15 puts would expire worthless and the 15 calls would be worth 58 cents at the moment, right? So that means we would keep the $2. That would drop our net on this thing to $13.60. Then all we do is sell the next group of puts and calls. I don't think Carlisle has any more puts and calls, but CG, let's see. No, March is still the furthest out month. So it's not about making money here. We don't really care what it is here, although we like it to expire worthless if it's possible. But it's not about making money on the puts and calls. It's about protecting ourselves and whittling down our basis. And when you plan to own something for 20 years, you only have to whittle down 5% a year, and you end up with a free stock that you're collecting a dividend on after 20 years. Hopefully we can do better than that, but that's just the outside example. Now let's take ARR, which didn't work out technically, right? Because ARR, we were a little too, well, that's not true, because if you look at ARR, we've sold many, many times. This is back from July of 2015. We've sold puts and calls over and over again, so we've collected probably as much money as the whole position is worth by now. But in this particular case, where was it? On 523. Oh, it's way back on 523. I was wondering how it could be so far off, but from 523, sure. I think at one point people were freaking out ARR was too low. Yeah. So back here, oh yeah, they were way at their bottom. So back here on 523, we did a protective sale because they had been going down and down and down. From 20, they were down to 18. So we did a more protective sale on ARR. Here it is. And we sold the 19 calls and the 18 puts, because at that point we were like, you know what, we'll be glad if the damn thing just holds that price. So here we are and seeing if we're true. So this is our big, well, the funny thing is we're only down $900, so it's really not even a thing. We are collecting, keep in mind that we're collecting $88 a month in dividends. So the dividends by themselves make up for this loss. But even so, we have the October 19 calls and the 18 puts. Well, the puts will expire worthless. The 19 calls are currently $3 in the money. So now we go back to the thing, and we go ARR. And what's our next sale going to be? Well, they go out to April. Oh, nice. Okay, good. We have April. And April is not trading heavily yet. But here's a good example. So the April 20s sold for $3. So now how much do we owe on the April 19th? We owe $3, right? So all we have to do is roll the 19s to the April 20s, and now we have now we're covered on that side. At the same time, we can sell. Let's say we sell the $22 puts for $220. So we're at 22. So let's say I'm getting a little more confident in AR. So I sell the $22 puts for $220. Now we've put another $220 in our pocket. And anything that ARR goes over 20 is in our favor, right? But even if it goes under 20, it's no big deal for us because we sold these puts, so we'll either buy more of the stock or we're going to roll those next time. And anything 20 or above, though, is going to make us some good money. So that's all you do. You just pick your next target and decide where you want to be. And keep in mind that in a vacuum, if we didn't already have these $3 that we have to roll, if we sell this for $3 at 20 and this for $2 at 22, that means we have a $2 spread. The most we can owe is $2. If it's a we're going to owe $2 on any strike in between 20 and 22. But our net is $3. So anything below 20 down to 17. So up at 17, we're flat, and at 25. Not 25. At 20. 20. Yeah, no, that's correct. At 25. So anything between 17 and 25, we're going to make up to $3. That's a very, very wide spread. And that's how we make money, though. We pick a target range, and in this case, because we're at a disadvantage, we're down 3. I would consider a wider spread like that to just make sure I get at least $1 or $2 of my money back. But you have a nice wide spread. You pick your target. If you come in your target range, you're going to knock $1 or $2 off your base price, all the while continuing to collect your dividends. So don't forget, if you've got an $18 stock and you're pulling in $1, let's say you just pull in $1 every $2 a year, and you knock 10% off the price every year. So in a year, you have an $18 stock you start with. It goes to 16, okay, and so then you got 16, 14, 12, 10, 8. So in 5 years, you have an $8 stock. And you're still collecting the dividend on a $20 stock. So your dividends now are going to be 20% of the money, of the cash money you've still got in the position, plus you've taken your $8 that you saved on the stock and you put that into something else. So now you have another stock that's bringing you dividend. Okay, this is what we call our planting trees system. Okay, there's a video called The Man Who Planted Trees. It's a short film. And if you watch it, you'd understand, but it's basically about our investing style. It takes many years to build these portfolios, but when you build them, they become very, very powerful over time. In fact, if you go to our education section, somewhere in the introduction, it mentions watching The Man Who Planted Trees. Very important thing to do. All right, let's see if any questions. You said in the past you don't like collars, but what about the collar on NLY or FTR? Well, I still don't like collars, do I? Because the way you do it, look, you have a collar, you're betting against yourself, right? Obviously, you're saying you're basically saying, well, I like NLY, but I don't want to lose too much money, so I'm going to buy a put to protect myself. That's essentially what you're doing. You're selling a long call, and you're basically paying for it. So now you're just in the NLY for it to make a couple of pennies, right? It's silly. Because let's take NLY, for example. Let's take Frontier, for example. Doesn't matter which one, but NLY. So NLY pays, I don't know what it pays. NLY. See, luckily I can find out by just looking. Oh, we don't have NLY. All right. Frontier pays. So Frontier pays 11 cents a share. Okay, great. So they pay 11 cents a share, and apparently they pay it every quarter. So I'm going to collect 44 cents a year on Frontier. And you're going to do a collar, theoretically. So you're going to do a collar. You're going to buy the stock for $4. You're going to sell the $4 call for 55 cents. And you're going to buy a $4 put for 40. No, there'd be no point, because if you're going to buy this put to 80 or 90, then you spent your dividend. So there'd be no point at all to that. That's again why I hate collars. What I would rather do is, why don't you just sell the $3 put? You can get 45 cents for the $3 put. That's your dividend. You aren't going to make any money on the stock anyway because you collared yourself. And the collar doesn't, only protects you so much. But if you do this, you're going to collect the entire 45 cents dividend up front that you would have collected if you owned the stock. You don't have to own the stock because you have the short puts. The worst thing that can happen is you get assigned the stock at net 250, and then you can do a collar. And then you'll drive your net to a nice reasonable level. So why am I doing a collar? There's no point. I can just sell the damn puts. Or you can just cover the stock, okay? Or you can buy it for $4, or better than a collar, I'd buy the stock for $4, sell the $3 calls for $1.15, okay, which is a teeny bit more than, it's basically the same as a dividend. So you might get called away, but if you get called away, you make your dime. Big deal. Don't complain. But now you've got $1.15 of downside protection. So I'd rather do that than do a collar, because a collar I'm betting against myself and throwing away almost all of my potential profit. Just if you don't like a stock enough to buy it, don't buy it. If you have a stock that you think that it's just as likely to go down as up, why are you in the stock? It makes no sense. Take a stock that you believe in. Take a stock that you have enough faith in to stick it out. Speaking of stocks, let's take a look at how we're doing. No, flatty, nothing going on here. Natural gas popping $3, so that's exciting. Thank God oil's not following it. Oil's still $49.80. Dollar getting a little bit weaker. Gold perking up just a tiny bit up. The yen, the Nikkei is probably going strong here. Whole lot of nothing going on futures-wise. All right, good. Let me keep talking. All right. So there's that. Didn't want to sell put on NOI after your 40% comment. Oh, but you've got to want it. I don't care if NOI goes down 40% because I want to buy it at 40% off. You're not buying the whole company, right? If you're buying the whole company, I'd say don't. We could go a lot lower. If you're not buying the whole company, you're just buying half of a tenth of a hundredth of a percent of it or whatever you're buying, then buy a small chunk. And if it goes up, you'll be happy. And if it doesn't go up, then you'll buy more and you'll lower your basis. But buy a stock that, if you're buying NOI just because it has big fat dividend and you don't believe in the company, don't buy it. Don't ever buy something you don't believe in long term. Don't ever buy a stock that if it goes down half price tomorrow, you won't want to buy more. Like Boeing. Okay, if a plane crashes tomorrow, like they had that battery fire a while ago, right? And the stock can drop 20% in a day. We wake up, it's 20% lower. The next day is next 2 days, another 20% lower. So what did we do when Boeing went 40% up? Well, fortunately, we didn't own it at the time. But when it did go 40% up, we bought the crap out of it. It's frickin' Boeing. They know how to make planes. Okay, they had a new design and the battery didn't work out right. There was a problem with the battery, so they take the battery out and they put in more of the different battery. But people are just insane the way they sell off stocks. The same thing with like Skechers when we jump back into it. We love taking up stock like that. Frontier right now. Frontier is investing money in an infrastructure bill. They've got some tight competition, and they're dealing with the changes in the rate rules. So on several fronts they have issues, but they've gone through this for decades. They know what they're doing. Just give them a chance. I mean, it's like if you have it's like if your kid's in Little League and the minute he strikes out, you're like, that's not my son anymore. He struck out, forget it. Look at the trend, he struck out twice. This is a disaster. You have to look at the whole of something and decide that it's something on the long term you want to make an investment in, not go every single day you're staring at like a couple of little squiggly lines to make your investment decision. See, when I said NOI is going to go 40% down, I'm like, I can't wait to buy it when it's 40% down. Not oh my God, it could go 40% down. I'm like, yeah, let me have that. Because I like NOI. I like the management at NOI. I like the way they hold it. I like the way they run their stuff. But meanwhile, rates are going down. Rates are going up. When rates go up, they're going to have tightening margins, and people are going to lose confidence, and it can easily go from 10 to 8 and maybe even 6 if the rates get tighter than we think. But don't forget, this is a stock that pays out, all of their profits are paid out as a dividend. Why are they going up in the first place? You know why they went up? Because people are chasing dividend stocks. They're not buying them for the actual value of the company, which is more like 8. They're buying it because it pays a dividend, and everybody's so starved for money, for yield, that they're willing to pay 25% over the proper price for it. So can it go down 20%? Yes, it should go down 20%. It's not worth 10 in the first place. Okay? Could it go down 40%? Sure. If anything actually does happen, it could easily go down 20%, but it's a huge buy down there. Just like it has been every time it goes down there, and we always buy when it goes that low. And Chimera is the same thing. Chimera is actually managed by the same group. This is the real value of Chimera down here. But because they pay like a 14% dividend, people are running into the stock at ridiculous prices. I'm not interested. I don't want to buy more here. I want to buy it when it's down here. And when it goes down here, I'm really excited to buy it because I know one day it'll go back to here. But if you're not going to buy things when they're on sale, when are you going to buy them? All right. What was I going to say? Speaking of on sale. There you go. That's a good transition. Let's transition now. Back in January. So this is back in January on the 7th. And I put up a watch list. Okay, and basically I put stuff in November also. These are the stocks we were watching for 2016. So what did we like at the beginning of the year? Because we're going to run out of the year soon on these things. So I like American Tower. I like American Tower because it's a good, solid company. It's basically a real estate play. They own the land on which you put the cell towers. That's what American Tower does, basically. So, as I said, real estate is a great moat. It's not like, especially this kind of real estate, because you need it to be strategically positioned in places where the laws allow you to put up nasty radio wave towers that are killing birds and people and whatever, and getting the permitting and the zoning, and it's all such a bitch that basically they've got a lock on their positions. Same thing with billboard companies. Billboard companies are great too for the same reason. So I like them. And obviously they've taken off nicely, blah, blah, blah. So not a bargain now, but just, this is the kind of companies we liked at the beginning of the year. Amarin we liked, and they flew up with biotechs. ASX, now they pay a nice 6.5% dividend, so you buy these guys, same reason, it's another dividend stock. Now, we didn't buy these things for the portfolios because when they got cheap, I don't know, we already had a bunch of stuff. I mean, when it did so the purpose of the watch list is to buy it when it goes lower, right? So when I put this out in November and January, we were hoping it would get lower, and then we buy it. So it did, it got lower, and then people could buy it. But it wasn't, not too many of these got officially added because we frankly had so many positions, there wasn't any room. But ASX is great, they pay a dividend. American Express, basically we liked them over here, because this was January 7th, so we liked them over here, they're back over here. They had a really good dip, though. But this is what I'm saying, you wait for things to go on sale. You put a list down of things you'd like to buy. When they're on sale, that's when you get it. Now, CPN, this is a good one. They're a utility company, natural gas, they have a lot of natural gas assets, and they're a utility company, and look at them. And they probably pay a good dividend. Let me see. What just happened? There they are. No, they don't pay a dividend. I don't know wonder nobody's buying that. Really? That's what they would pay a dividend. No. Oh, you cheap bastards. All right, well, so much for that. So Calpine doesn't pay a dividend, which is surprising. And what's been happening to them lately? Wildfire, that's one of the worst things. It's probably in California, right? They sold their Minnesota plant for $395 million. That's not so bad. Blah, 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 blah. Calpine's a cash flow machine. That's my impression of them also. Interesting. I guess it's because they don't pay a dividend. Nobody's interested. So I like them. And there's one that can be played, which is the purpose of what I wanted to do is look to find out which ones we could play. What happened? This one. Yeah, okay. So Calpine's another one, though. Now, this one, of course, you're not buying it for the dividend. But then you say, okay, well, now CPN's on sale. So here's a stock we could actually look at, right? So CPN. And we see how far out they go. Hopefully far. Yep, January 18, fantastic. So you buy it for $12.42. You sell the $12 calls for $2 to, let's say, $2.25, right? So you sell these for $2.22. Now you're down to just about 10, and then you can sell the $12 puts for another $1.75. All right. So now you've knocked. What do we say here? $2.25 plus $1.75. That works out. So that's $4. So now you've knocked $4 off the price by selling the $12 puts and calls. So in your first purchase of this stock, with just over a year, with 15 months to go before expiration, so in your first 15 months of ownership, you've knocked $4, 35% off the price in your first year of owning it. And if it ends up being flat at 12, your net is $8.50. Okay, so you're going to make $3.50 which is a lot, whatever that is, 40%, something like that. You're going to make 40% in a year with that completely conservative play. If it goes below 12, you have your 850 base that you're buying for now, plus 12 is 20.50, divided by 2 is 1050. So your break even in a year is 1050. That's almost 20% below where you are now. So you have a 20% downside protection on the stock. And if you get called away at 12 or more, obviously we would roll it though, but if you get called away at 12 bucks, you're going to make 40%. So you have 20% downside protection built in. You make 40% if the thing's just above where it is now. And anything in between is just crazy. That's the way you buy a stock, okay? And that's what the watch list is for. It's low in the watch list. We still like the stock. You always look. I mean, why is it low in the watch list? Why does it make no progress this year? But it's not going to make no progress. Every time it goes down here, it goes back up. So now it's down, cycling back down. It'll probably go back up. Cisco got away. Decker, as I said at the time, too cheap. That went flying up. See, unfortunately, my problem with watch list is I'm very good at picking stuff, so it's not like a year later you can go back and get the same thing. I have to make a new watch list for this year. For next year, I mean. Doc is another REIT. Oh, this is a great one. This is a REIT for medical properties. This is a juicy one. When they come back down, I would keep an eye on them. Okay, medical property REIT. Doctors, they don't know what. Doctors overpay for everything in their spaces. It's amazing. ETP is natural gas. MLP, of course, everything to do with natural gas. We were loving at the beginning of the year. Ford, cheap again. So that here, when we like Ford whenever it goes down. We just added Ford again when it hit 12, though. I don't think it's ever going to get back here again, but we like Ford down here. Fortress is another good one, pays a 5% dividend. Again, most of these got away. Gilead, now I bang in the table for this whole time, ever since we went below 80, I've been pounding the table on Gilead. Still like it. It's on the watch list. We still like it. There's no reason it should be this low. It's ridiculous. They do have a pipeline issue. Genworth, I asked the question down here, have they suffered enough when they were down here at 250? I'm like, I think they've suffered enough. Apparently they had suffered enough. They're now up 100% from there. IBM. Now, I wrote this in January. It's weird. It was really our stock of the year runner-up anyway. So we were between IBM or natural gas for the stock of the year, and we ended up choosing natural gas, which was the correct choice. But IBM also had a very good year. IMAX. Okay, here's IMAX on our watch list. Still where we like them down here. So IMAX is one on our watch list that's working. Intel totally got away. INO does vaccines. They did great. Kindi, this is an electric car play. And they're cheap, so here's another one you can get into still. All right, this is just a fun play, which means we don't, it's not like I'm not going to put my life savings into it, but it's kind of a nice little electric car. So I think Buffett's got money in this thing. So they're in China, so you don't hear much about them, but they'll be here eventually. Las Vegas totally rocked it, 50% gain since we picked them. OHI is nursing home REIT, also good growing thing, nice. So they're coming back down, so that's going to be one to keep an eye on. Shell Oil, best of the worst. Look, I picked the only oil company that did well this year. That's pretty good. RF, I said possible takeover. It's a low-risk bank, and it turns out they flew up like crazy. Super Value, pretty much flat for the year. I like Super Value. Anytime Super Value is down below 5, I like them. Walmart, they got away from us also, but and we have them. Not they got away from us, but I mean, just they got away as far as getting this new place. All right, so not the best place to look right now for things because there's a couple of good ones still. Now, in August, I looked at these. I said these are ones that are good in the bull market, and let's see how these guys are doing. Now, how am I going to do this? I'm going to put that up, and what can I do? Open image in a new tab. There we go. Now this isn't going to work. Smaller, smaller. Okay. All right, so what were we looking at? We were looking at BMY. All right, so in August, so BMY is still cheap. WFC, these are all ones that are considered for next year's watch list. Wells Fargo, obviously they went on sale because of their problem, but I'm not sure they're done with their issues yet. But when they get rid of the CEO, the stock is going to pop. Disney's still cheap, and we're happy with them. Ford, we just talked about. H&R Block is always fun to get this time of year. They start to perk up around tax season, so it's a good buy right now. Harley, not so bad. WBA, not so bad. WFM, Whole Foods, good price on Whole Foods. Mondelez is drifting. So all these guys, if they go on sale, we're going to like them. Deere's perking up, actually. Because Cadillac did good, too. ACAM. Okay, they're drifting along. So remember, the purpose of a watch list is when they get cheap, we want to buy them. It doesn't mean buy them now. It means we want to keep an eye on them, watch them, if you may. And if they get cheap, then we make sure they didn't get cheap for any bad reasons. And we want to pick them up. Oh, Weatherford's good. And Frontier is on my list, too. So Frontier did get a little bit cheaper. All right, so that's what a watch list is for, and we keep them all the time. We always have a watch list. We always have, on occasion, when the whole market goes on sale, we turn a watch list into a buy list, and I'll pick certain things that we want to absolutely buy. We haven't had a buy list since, September, was it 2 years ago? It might have been 2 years ago in September we had a buy list. Well, sure, it wasn't last year, so it was 2 years ago, September. We had a nice market sale and we made a buy list. That was the last time we had a buy list. So the market hasn't been actually given a good enough sale since that time. All right, let's see how things are looking. Drift, boring. Boring. Natural gas is exciting. Everybody else is drifting. Okay. Nothing to see here. Move along. All right, so that's that part taken care of. I'm very happy. Let's see if there's any exciting news going on. News. Ew, what's this? Why is it like that? Maybe if they're not signed in, is that one? Sign in. Oh, I don't know my ID. All right. That's weird. Sotheby's, we like Sotheby's. Harris, Chorus, Compton, Jamie Dimon, Catalyst, Gainers, Wells Fargo, Google. Uber self-driving cars are not doing well. They're banging into things and getting into accidents and so on and so forth. In Pittsburgh, they're doing a test. So it is, believe me, Google is, see, this, it's a funny thing because Uber, young company, not, I don't want to say irresponsible, let's say not as responsible as Google is about things. Google built a city, a little town, where they have fake people and robots running around, and they have the cars driving all over the place in the fake town, logging millions of miles to make sure every possible scenario is covered. Uber is like, oh no, let's just call a car company that's willing to give us some cars, and we'll outfit them with whoever says they have the best stuff, and then we'll just throw them on the street. That is not the way to do it with self-driving cars. And this is why the government, unfortunately, is stepping in and regulating it, because they have to. If people like Uber weren't running in there and running their own tests in live situations, the government wouldn't have to step in. But the government is stepping in because Google's doing it responsibly, and the government didn't say boo for the last year. And Google is putting cars out in San Francisco and stuff. But Uber's just rushes off to the races. Nobody's tested their stuff. They didn't do any internal tests. They're doing tests on the street to see how it goes. It's not going well. I like that, but nobody believes them. Oil rally to top out soon, says Goldman. Global oil market very oversupplied. Well, I said that. Particularly as disrupted output from Nigeria. Okay, so that's the rebel stuff. And Libya return. Goldman Sachs chief. We're still seeing a lot of oil into the market, making it tough for it to get north. See, but they said 55. The fact that they said 55 makes everyone say, "Oh, we're only at 50, so 10% up from here." That's not what they mean. Any supply shortage in the market is years off. Wow, that's not good. He's talking about possibly anything that could push it into triple digits couldn't happen for 3 years at least. I would say so, at least. That's crazy. And let's see what they said in September. They cut their forecast in Q4 to 43 from 50. See, here's the thing. So what did they say here? See, they didn't change their outlook. Their outlook is still 43 for Q4. But just because of the way he said it, it's being taken a little bit out of context and encouraging the market. Ooh, GDP forecast stopped dropping. There's good news. This is the Atlanta Fed's GDP forecast. Look what it's been doing. So it finally stopped falling. That's huge. Okay, so this is a big break for us. It had gone down from 2.8 to 2.2, and now it's steady at 2.2. They're not actually forecasting it to be much worse so far. That's the forecast for Q3, which obviously we're done with. So it's steadying up a little bit and firming up at that price. All right, so we talked about that stuff, and today I was talking about things we're worried about. Here's a good point that I wanted to make, right? So, somebody made a comment today, not one of the members, but somebody else I was talking to, and they said, well, all this problems in the market that you're pointing out aren't affecting the market because we're up today. So he goes, despite all these things that are a problem, we're up today, so therefore I don't think it's something we should be worried about. And that's just basically idiotic. Okay? It's the same logic as when Senator Sununu brought a snowball into Congress and held it up on the floor of Congress and said, look, global warming's a hoax, it's snowing outside. Okay? Just because something contradicts something doesn't mean the thing it's contradicting is completely false. It means they're aberrations. In this case, we're seeing signs of weakness in the global economy. Dangerous signs. So if there's a bubble, let's take an easy example. Here's a balloon, right? Okay? I'm telling you that if you keep putting air in the balloon, it will pop. But you put in air, and it doesn't pop. Therefore, I'm wrong, right? And I'm telling you again, if you keep putting air in the balloon, it'll pop. And you put in more air, and it doesn't pop. Now, what I'm doing is I'm pointing to, but the surface tension, I'm being scientific. I'm saying, but you don't understand. I'm saying the surface tension on the balloon is now 50 psi, and at 55 psi, there's no possible way it can go any higher. And also, the air pressure inside is X, and the volume of air inside is X, and most of these balloons don't hold more than this much volume. There are certain things that you see happening that are true. Yet, you blow up the balloon a little bit more, and it doesn't break yet. Therefore, you say, well, let's blow it up some more. And I'm sitting there saying, but you don't understand. It will break. It absolutely will break at some point. I don't know when exactly. I don't know you blow up a balloon, you don't know exactly when it's going to pop, but it will pop. I'm sure you've all blown up an amazing balloon that blew up way bigger than you thought, and you're like, oh my God, look, this thing's still going. But they pop. Bubbles too, same thing like blowing an actual bubble. Like sometimes you get a really big one, and sometimes it's a big round sphere and it goes off into the air and it floats around and you're like, wow, that's lasting a long time. But do you think it's not going to pop? No, because you have this vast amount of experience. It tells you it will eventually pop. Okay? This is not different. The less you understand something, right? Your kid might look at this bubble that's floating around and thinking it's never going to pop, right? They think it's going to go up into space, or the balloons too, right? The balloon, you let go of a balloon, it goes in the air. They're like, it's going to go into space. It's going to become a planet, blah, blah, blah. You know that's not true because you have experience, okay? I have a lot of experience. so I know it seems like sometimes that you say, oh, we can just keep buying and buying and buying and go up and up and up, okay? Now, my experience includes, though, 1999, when I would look at this stuff and I would say, hey, this crap is overvalued. Yet all the crap that was overvalued became 50% more overvalued, 100% more overvalued than it was when I said it was overvalued. Now, a year later, everything was lower than where I said it was overvalued. So I was right, but I was wrong about the fact that it could have doubled before I was right. So that's what this stuff is, okay? I'm pointing out things that are bad. They're not, I mean, look, we wouldn't have a long-term portfolio that was up 125% if I knew when things were going to break. We have longs. But I'm very, very worried. And I print these things because I want people to understand what I'm worried about and what I'm seeing. It should not, because when these things start hitting the fan, you'll know, oh, okay, that's because of this and that's because of this. You've got to take these things seriously when people start paying attention to them. So I'm talking about here the PMI numbers, terrible. Here's a recession. Here's a good market. Here's a recession. Here's where we are now. We're not good. Here's a good market. Here's a recession. Where are we closer to? It's not an opinion, it's a fact. These are measurements. Deutsche Bank, almost one of the biggest banks in the world, is teetering. Credit Suisse. If you start hearing more about Credit Suisse, you'll know that Deutsche Bank is contagious. We talked about now, Spain has no government. They're going to vote to put a government in. That government could be hostile to the EU. France also putting in a new government might be hostile to the EU. Germany is the EU. But they're voting too. Now, Merkel bends over backwards to keep the EU functioning. What if the new person, if Merkel goes out, we could have a new person in Germany who says, screw you guys. That would be a problem. Italy is voting to change the entire constitution of their country so that they're going to give the individual states more power. And the states, the way they're doing it, it could lead to a Brexit kind of referendum where Italy might leave the EU. Not all at once, but just, the government changeover can then lead to more power to the people who want to get out of the EU. Because Italy doesn't like the austerity programs that are being forced on them either, and they're in bad shape. You could lose Spain, you could lose Italy, you could lose Portugal. So Europe could start falling apart very fast. And again, this is also why I'm long on the dollar, though, because I think ultimately the euro will fall apart a bit. If not totally, it'll certainly go down because people are going to lose faith in it. That'll make the dollar stronger. And Japan can't afford the yen to be any stronger, so they're going to push to make the dollar stronger too. And if they can't push the euro up, Japan has no choice. They have to push the dollar up. They got to push something up to make the yen weak. There's really only two things they can do. They can either push the dollar up or push the euro up. If the euro won't go up, the Japan has to go full bore pushing up the dollar. Also, then this morning, I'm like, retail sales in Europe are falling off a cliff. It's down 1%, but it's down 1% after they adjusted. No, I'm sorry, this is Tokyo. It's down 1% from July. But it's down 0.6%. I mean, 0.1%, sorry. It's down 0.6% from last year. That's not good. And Germany had a decline in retail sales. If Germany's not doing well, who is doing well? China, this is the worst. August retail sales were up 10.5% from last year. But they revised July down 7.7%. So July was actually terrible too. It's just that at the time they pretended it was good, and now they're admitting it was terrible. And that's another big, big danger sign when you see governments are willing to I mean, come on, this is just fraud. This isn't a human error when you're off by 7.7%. That's fraud. They're just purposely messing around with the numbers. And meanwhile, the government is maintaining a forecast for 10% growth. That's just insane. Then we've got this debt issue. I've been talking about this for a couple of weeks now. The Chinese debt thing is completely out of control. These are 150% of GDP. Now we're up to 250% of GDP. This is in the last, let's say starting here, 2008. So this is in the last 8 years. Their entire GDP of additional debt. That would be like us adding $20 trillion. That's like, well, obviously, it's like adding the entire national debt to the national debt. That would be like us adding $20 trillion to the national debt. Now, meanwhile, when you divide 100 by 8, that's 10%. The debt is more than their growth. So it costs China more money in debt every year than they get back in GDP growth. That's how they're growing their economy. You can grow your economy by 10% if you borrow 10% to grow your economy. But what they're doing is they're borrowing 12%, 12.5% to grow their economy 7%, which means that on the whole, their economy is naturally contracting 5%, and they're papering it over with debt. All right? These are the things like, when I say there's a problem, and I think there's a worry about the general economy, this is the kind of stuff I'm talking about. 1/4 of the Chinese companies don't make enough money, don't have enough profit to pay the interest on their debt. And they're taking balloon loans that have no or low 5-year rates. So in other words, here they're borrowing money at 1%. They borrow $1 billion at 1%. 1% of $1 billion is $10 million. Right? Yes. So the company borrows $1 billion, and they have to pay back 1% interest for 5 years. So that's an interest-only loan at 1% for 5 years. So all they do is borrow $1 billion, take $50 million, and put it aside to pay off the loan. Right? So the interest on the loan, and then take the $1 billion and gamble on something that works. Now, why does the company want to do this? Well, first of all, this is a big scam. A lot of these guys who run these companies are running a scam essentially, and their primary goal is to get their $1 million salaries every year. And if they think it's only going to last 5 more years, that's fine with them. So they'll squeeze another 5 years out of it by putting the company more in debt. And if the company goes bust 5 years later, that's fine with them too, because they'll be out of there. You know, you've got capitalism on steroids over in China. It's like the Wild West. You have all these guys who 10 years ago had $20,000 a year jobs and are now CEOs of companies drawing $1 million salaries. They are rich beyond their wildest dreams, and it's like a big game, and it's only going to last for a certain amount of time, and then then a lot of these companies are going to implode in on themselves. And they're going to take the global economy down with them. When? I don't know when, because the government is complicit in it. It's not that the government's not regulating it. The government is complicit in it because a lot of the government officials sit on the board seats and they're getting huge paychecks. You look at the wealth growth of the Communist Party in China, they're all getting unbelievably rich. It's not much different than the Russian oligarchs. This money's not going to the people. That's why Apple is still paying people 50 cents an hour at Foxconn. Okay, and that's what they pay Foxconn. Foxconn gives the people half of that money. So the money's not trickling down to the people. The people aren't getting wage increases or anything like that. It's a disaster. All the money is going to the top 1% of China, which are mostly people who are members of the Communist Party. So they have no interest at all in this little game ending. And so they are encouraging the banks to give the corporations interest-free loans, balloon loans. And they're playing the whole game for them is to get another 5 years out of this thing. After 5 years, if everything collapses, they won't, believe me, they'll have their money moved to other places. And then like, look, don't forget Japan. It's the grandmother of all disasters, Japan. Japan's debt, the interest on Japan's debt, even at these low rates, servicing the interest on Japan's debt is taking up 1/3 of all of the government receipts. So in other words, all the money the government collects, 1/3 of it goes just to pay the interest on the debt. So if the interest on the debt goes from 1% to 2%, then 2/3 of the money Japan collects will be going to pay their interest. If it goes to 3%, then all the money Japan collects. Japan will have no government. At 3%, Japan has no government. Or they have to double or triple or whatever their tax revenues, which obviously won't stand anyway. All right? So these are the things that really concern me. And again, it's not keeping us from buying stuff, and it's not making us dump our whole portfolio, but we're watching these things. And if I have to remind you guys every week that we got to watch these things, then I have to remind you every week that we have to watch these things, because it seems wonderful when the S&P pops up. And we have these great days, but let's take a look. What's that? Well, let's take a look at the volume here. So here's SPY, and here's history. Look. All right, so here you go. Yesterday, we sold off, and we had 118 million volume, right? Today, it's 230, 44 million. Oh, and I called it, right? Didn't I say 100? I said, when it was at 80, I said we finished the day about 120. So that's where we are. Today, we're at 40. We're going to finish the day more like 80. If that, I don't even know if we're going to get to 80. So on an up day, significantly less volume than on a down day. That means the money is still flowing out of the market. Okay, here's a down day, 128. Here's an up day, 117. That's not bad for an up day. Here's a down day, 85, finish lower. Here's another down day, 118. So really, though, what you're looking at is you get 117 up, and then you've got 2 down days with 200 down. Then you have an up day, 80 up, whatever. The volume is flowing out. Money is getting taken out, and what they're doing is they're ramping it up in the mornings or whatever. Here you go. Let's look at the hourly. Okay, well, it's hard to tell because this is 6 p.m. these lines. The day starts at 6 p.m. in the futures. But they ramp it up into the open pretty much every day, ramping up into the open. Here's ramped up. See, here's where the volume begins. Ramped up into the open, ramped up into the open, ramped up into the open, and then the selling begins in actual volume. Look at the red. That's selling. This is buying. This is buying. Look at the total volume, right? This big thing, selling, little stuff, buying. Selling, 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 buying. Here's big selling over here. That was Friday's joke of the day. Big red things here, red selling. So you can see, even on the volume charts, you can see what's going on. And money is creeping out, not in. So we're coming back, but we're only coming back to where we were. We're not making new highs. These are not new highs. You have to have that longer-term perspective. On a weekly basis, no, that's too much. On a daily basis, we're only where we were in July. Gone nowhere. And here's what happened. Here's another time we went nowhere for a few months. Which way does it resolve? Without fresh stimulus, without some new fancy way to boost the market, we're going to go down. Don't know when. Don't want to make a prediction when, but I do want to make. I have made a prediction when. We got very cautious in July, and we have not changed since. We're still very cautious, and we've certainly given up on potential gains that we could have had. But I'd rather make sure we have our money on the way down. So I'm going to remain cautious. I just can't do anything else. And then today I was writing about why that's happening. A few words on how to properly invest in your children's education. Oh my God, are you kidding me? That's a long topic. We did this in chat. On the weekend we were talking about it in chat. But how to invest in your children's education? Well, the best thing is those 529 plans. Those are tax-free. If you get a good early start and you put money in, they're tax-free, and a gift tax is tax-free anyway. So you can put money, on a 529 you can put, I think, $125,000 in just to start it off. But every year you can give like a $10,000, $15,000 gift tax to each one of your children. Get tax-free gifts to each one of your children. You can give that a whole lot. You can always give your children $10,000 or $15,000 a year tax-free. So if you want to build a portfolio for your kids, that's one way to do it. The nice thing about the 529, though, is it doesn't really affect their financial aid. So if they qualify for financial aid, that doesn't really count against them, which is very, very good, actually. So if they get a scholarship or something like that and it's got merit and it's got needs, it won't affect them for the needs. Now, as far as stocks, though, I like to buy the kids stocks of things that they use. So all throughout their lives, I'll buy Hasbro stocks when they like certain, when they're playing with Barbies. I'll buy Mattel stocks. I have girls. They like going to the movies. I'll buy the AMC stock. We watch HBO. I get HBO. We get Disney. I like to buy stocks that they have some relationship to, so that there's a company that prints up stock certificates, which is nice also. And you can get a nice printed stock certificate from the companies that you invest in. And I have some of those for the kids, so they get to hold it in their hands. Say, okay, here's your stocks. They actually have a place where they say these are they're not all their stocks, but these are my stocks. They know they have these stocks. So they actually own this company, and it makes them a lot more interested in what's going on. They go to the mall. They care about what's it look like, how are the sales. It's an interesting perspective they get on these things. For me, I like things that pay dividends, and I like things that are simple. And again, my one thing we were talking about in chat when we were having a big discussion about this is I've seen many, many family trusts in my time. And the chances of the second generation of kids caring about anything that has to do with that trust is practically zero. There'll be these family trusts that affect like 100 people, and if 2 people care enough to meet with the lawyers, that's an amazing thing. Everybody else just wants their checks. Whenever they have a vote, it's all about, like, when do I get my check? That's all they care about. It would be silly to expect more from your own kids, believe me. So basically, you just want to set up simply as possible, and you want to pick blue chip stocks that are going to pay over time, preferably ones with dividends, that you can go into a very simple strategy, like when you're not paying attention anymore, when you retire, when you don't want to deal with it anymore. You want to have a very simple strategy where just sell calls every month, just do simple covered call strategies every quarter or whatever, and collect your dividends. That's basically all you want to do with these properties. And you just have them for life. Because think about it, who are these rich, when we were kids, who were these really rich old people, right? They were the ones that bought IBM in 1930 and never cashed in. They had AT&T their whole life. They have Standard Oil stock certificates, okay, even though they changed the name to Exxon. They're like, it still says Standard Oil on their certificate. And since it's like split 20 times, it's worth $50,000 a share. These are the guys who get rich, the long-term holding dividend stock people, the ones who make the money over time. So that's how you want to set up your kids. Mindless, good investments that are going to grow when the country grows. That's the way to start investing for your kids. Looks like we're going to get inflation if the bond yields are right. We're going to get inflation for sure, and I think a lot of it. And we talked about that too. The basic thing on inflation, of course, is there's all this money, obviously. The Fed has put all this money out, but it's not moving. So once that money starts moving, the velocity of money times the amount of money that's out there is going to cause some pretty serious inflation. And like I was saying, I forget when I said it. Was I on TV? I don't know. I think I said it on TV this week. The really big thing that happens is these minimum wage rules that are kicking in, right? Let's say they affect 20 million people. And next year, and it's incremental. So wages are going up from $8 an hour to $12 to $15 an hour in the next 5 years, let's say. So every year, at least, we go up $1. So what happens next year? Next year, 20 million people get $1 more per hour. That's $80 million a week. That's a lot of money. So, and I'm sorry, with 20 minutes, it's $800 million a week. That's a lot of extra spending money that flies into the system. And it goes right from the bottom, and that money, when you give it to minimum wage people, that money gets spent immediately. It goes, and so where does the money go? When you get this, why it's so much better to give money to people at the bottom. You give somebody a worker who's making $320 a week, and now you give him an extra $40, and he's got $360 a week. He's not banking that. He's not buying stocks with that. He's going to a store and spending it. Well, that's multiplied money, right? Because his $60 that goes to him, instead of going, if McDonald's keeps the $60, it goes to McDonald's headquarters and becomes part of their profit, and an extra 1/10 of 1 cent goes to every rich shareholder of McDonald's, right? Or 100% or whatever it ends up being. But if you give that $60 to the guy at the wage who's earning the money, that guy is going to go straight out and spend it. The guy he gives it to is most likely going to go out and spend it too, or some percentage of it is going to get spent and not get captured by a corporation. And the money flows through the community. So when you distribute money at the top, it has a 0.5% multiplier. In other words, every dollar you give to rich people, half of it goes into circulation. So you give $1 billion to rich people, and half of it goes to circulation. 500 million gets circulated. You give $1 billion to poor people, $3.2 billion gets circulated. It's a 3.2 times multiplier, giving it to poor people versus giving it to rich people. So the Fed, had they given $6 trillion to poor people instead of rich people, would have doubled our GDP. But instead, they basically wasted the money. And then the sad part is that the poor people have the burden of paying it all back, which takes more money out of their pocket over time and deducts 3.2 times whatever they lose. Like when you lose the food stamp money, when you take away that food stamp money, 3.2 times more money is taken away from the people that those people buy from out of the economy. So when you cut that program, you're gutting the economy when you cut food stamps. Anyway, all right, do you have a recommendation of where to put your cash until you're ready to invest? Well, sure, we do. I mean, look, we're dabbling. We play the future sometimes. Like I said, there's dividend-paying stocks. We just went over a whole bunch of stocks. There are dividend-paying stocks that I don't mind owning. Even if they go down, we'll just buy a little bit more. There's nothing, that's the best thing to do is just put it in a nice, steady dividend-paying stock that you want to buy a lot more of. Sell puts on stocks that you want to buy when they're cheap. Because all that's going to happen if the market drops 20% is you'll end up buying the stock cheap, which is what you want it to do. If the market doesn't drop 20%, you'll get a lot more money than the dividend would have been. So, for example, let's say Ford. Let's say a nice safe one like Ford. So Ford is $12.50. So I'm not saying you need to buy Ford, but you take your $12.50, right? So let's say you're $12,500. So you want to buy 1,000 shares of Ford, but you don't have to buy 1,000 shares of Ford. What you do is you sell the Ford. Is this 2018? So you sell the Ford 2018 1175 puts for $1.35. That's going to net you into Ford for $10.40. All right, so $10.40 is $2 off, so it's 15, whatever it is, 15, 17% off the current price of Ford. So your worst case is you own Ford for $10.40. That's your worst case. Otherwise, if Ford is over $11.75, which is higher than it is right now, you will make, well, you won't make, you get to keep the $1.36 because you sell for $1.35. You get to sell for $1.35 these puts. You get that money right away. You have an obligation to buy Ford for $11.75 if it's below that price. But if Ford never goes below that price, you're going to keep the $1.75. You're going to keep the $1.33. That is more than 10% back on your cash, which you're not even using. And not only that, though, but your cash commitment is only, if you have ordinary margin, your cash commitment is only 50% of that anyway. So your worst case is you'll end up committing half your cash to owning Ford, which pays a nice dividend. And then you could sell more puts and calls against it and lower the price even further if it gets assigned to you. Or you're going to get 10% back on your money, which is, what, 3 times, 4 times what you're going to get if you put it into T-bills. So there's really, to me, there's no downside. I mean, and again, it goes back to, as long as you really want to own the stock. So if you're in cash, you find stocks that you really would like to own for 20% off. You sell puts at a 20% off. And that's that. And then you pick the stock. You say, okay, fine. So my worst case is owning. Make sure you get your allocations right, though. Just pick the right amount. Take a good allocation. And say, okay, and don't overexpose yourself because you don't need to get 10% back. In other words, like I said, you're only exposing, realistically, if you net into Ford for $10.40, you only need $520 to cover it. So $5,200 will cover this. But just because you can get paid $1.35 on $1,350 on a $5,200 commitment doesn't mean you should take your whole portfolio and do that. Doesn't mean you should allocate all your possible margin to that, because that's how you can get in trouble. But when you've got $12,500 and you commit $5,200 to making $1,300, you're going to net back 10% plus on your money, and you're barely committing. You're in no danger whatsoever of getting burned. I mean, obviously you could lose a bit of money, but even taking a loss, even if Ford goes down to $8. Okay, you're only going to lose a net of 8 to 1040, which is 240 times 1,000 shares is $2,500. So you're risking at most a 20% loss. If Ford catastrophically collapses, you'll be down 20%. Otherwise, though, you've got a very good chance of making your $1,300. And again, that goes back to the same thing, though. If Ford's down to $8, unless something incredibly horrible happens that the automobile industry is never going to recover, I'm more likely to double down on them than to sell. And again, that's just Ford. But go back over this thing when we do the replay of the webinar, write down all those things we just went over on the buy list, and say, hey, if those things get cheap, I do want some of those things. USO November 13 put, can you please review the logic on the 13 put? Well, the logic is that we think oil is going to go down at some point. So far, no good. Energy, oil. Not even close. Look, oil, this has been a good top of the range, $50. The only reason it's up, we have the OPEC deal, and now you have a hurricane. But the same thing happened here. We had an OPEC deal pending, and whatever other factors that they managed to jack it up from 40 to 50. Now it could go to 55. It's possible. But if we do go to 55, I'll short it some more. But over 50, I would stop out of my shorts right now. But as long as we're under 50, I think this thing's going to peter out in the next couple of days. And and we have a very good chance of getting a nice retrace. In fact, possibly something like we got last year. Where are we now? We're in October, right? You see what they did last October? We're in the same place. They jacked it up last October, then the big, long collapse. I'm hoping that by mid-November, we'll be here. All right, which is $10 lower than we are now. If we're $10 lower than we are now, that's going to be a hell of a trade. All right, so when it was 12, when USO, let's go back to USO though. So with USO, a couple of days ago or last week, we liked it when it was coming up around 11. We said, "Oh, that's getting tasty here. We want to short it." It shot up more since then. But all we did is roll. We had the $12 short puts, not short puts. We had the $12 long puts that we paid $1.50 for, right? That nets us in at $10.50. So anything below $10.50 is a winner. Now we've rolled to the $13 puts, and we're net 2 on those. So now anything below 11 is a winner. So we're not in worse shape at all. We made a roll, we adjusted, and we doubled down, but we wanted a bigger position. We took a small position in the first place because we thought oil would go to 50. We were just worried it wouldn't. When we initiated that position, our worry wasn't that oil would go to 50, it was that it wouldn't go to 50 because we wanted to buy more. We went in early just in case we didn't get to our $50 goal. That was worrying us. So when oil was like $47.50 or $48.50, we took a short just in case it never made it to 50. But our target was always 50. Our target was always 11.50 on USO. And now we're waiting for it to go back to the bottom of the channel. We want to see at least this $10 here. So that's the logic of that trade. I mean, there's no, they always come up with reasons to push oil higher, and there'll always be, people are going to come up with, there'll be articles and people talk about $100 oils right around the corner and whatever. That's the time you want to sell oil. When people are buying it for things that have nothing to do, you can predict anything you want. But the fact of the matter is, this is how much inventory there is. Oh, you know what we didn't do today? That's important. EIA, Petroleum Status Report. Petroleum Status Report. We didn't look at what actually happened in the inventories. Nope, don't have long to go. So here's the 1 o'clock. So what actually happened? Imports, 7.7 million. Whoa, imports are so low. That's one thing. Although, frankly, they're not lower than they were. They've been low. Exports, look at exports. Exports went up 300,000 barrels a day from last week. From last year, they're way up. They're up 300,000 barrels a day from last week. So that's 2 million barrels additional exports from last week. Nothing really strange here. Crude went down, gasoline flat, distillates down. Other oils, strangely, went down quite a bit, and SPR flat. Overall, we have this drop. So for whatever reason, other oils took a big hit, and that's one of the big reasons we have such a draw. This time, usually other oils has a build. This time, for whatever reason, other oils went the other way. So the commercial crude went down 3 million barrels. At 499 million barrels, inventories are historically high. Total gasoline increased by nothing, and they're above the upper limit of the range, of course. Finished gasoline and distillates decreased by 2 million barrels above the upper range. They don't really comment on what happened, though. But as you can see, look, see the product supply? They talk about demand being higher, but how is demand being higher when they're not supplying more product? And the demand is in this other oils. It's not like people are driving. This isn't gasoline. The gasoline demand, 227.2 last week, 227.4 this week. That's demand. There's no change. Meanwhile, oil is like 10% more. in a week. Amazing. It's more than that now. Now it's 50, so it's like 50 is 15% more in a week. So some crazy stuff. So there's nothing telling here. A little bit of increase in exports explains some of the draws of the gasoline and whatever. But on the whole, it's not any great. There's no great sign here of an increase in demand. That's the key. And if there's no great increase in demand, then what the hell is everyone getting excited about? And mostly it's a storm. In fact, I had a thing on that. Where was that? Here you go. So here's the hurricane. It's right around here now, around the Bahamas. See, it says Matthew. It's just coming off of Cuba. There's the Bahamas. It's over here. Now, the track of the storm, they're pretty sure about this. So this is the band of the storm. And the track of the storm is probably going this way, coming around this side of Florida, where my mom lives, right there. And but here's the funny thing, though. Here's where all the oil is. Over here, see this brown stuff? These are the oil wells. There are no oil wells, zero, anywhere near where the storm is actually going. Now, there are tankers that come in, and they're coming to the Gulf of Mexico, and they like to go this way, so there's a disruption of tanker traffic because they're trying to go here, and they can't because there's a great big hurricane on the 5th, 6th. So there's an entire day when, and well, I would include today too. So it's really about 2 full days where tankers really either can't get through or they got to go way, way around. So essentially they can't get through. Either way, they're going to be delayed. Because I know when we take the cruise ship, it takes like a day to go this far. So, and tankers are slower than cruise ships. So I have to imagine that it wouldn't be worth it for them to go around. So they probably just park over here and wait. So you got 2 days of disruption of oil coming in. That's going to obviously affect next week's inventories. So we have to expect that. It's not going to be a surprise. Meanwhile, though, another funny thing that happens, though, is their oil can't leave. They're shipping oil out. So these exports that they usually do, they're going to drop off, and it'll probably even out with the amount of imports that aren't coming in. Because we don't get most of our imports from here. We import 7 million barrels a day. Only about 2 million barrels come from Saudi Arabia, and on this way from Africa and Saudi Arabia. Most of our oil comes from Mexico, and it comes from Canada. It has nothing to do with this storm. So there's no logical reason to take the storm. It's just an excuse, and the traders use the excuse to jack up the prices. The TV people use it as an excuse to talk up the prices. They're doing it right now. Right now on CNBC, crude oil approaches $50 is their headline. All day long they've been talking about oil because they're so excited it's getting back to 50. Gasoline, no, I wouldn't bet on gasoline because that's completely a random event based on refining capacity, so on and so forth, and it could go either way. It's not when it's low, we like playing. The only thing about gasoline, when it was low down around 140, we like playing it long, but we don't have a reason to short it, and we also don't have a reason to think it's going to go higher than 150 right now. If Europe falls apart, would the dollar and gold go up? Well, the dollar and gold, yeah, that's actually interesting because yes, gold shouldn't do so badly if it's the euro that's falling apart. At the moment, let's go weekly. Really, the euro hasn't gone anywhere though. The euro's kind of flat at 112 for like the last year. The dollar is also pretty flat, so neither one has gone anywhere. The yen has gotten stronger. This is annoying the crap out of poor Japan, because they don't want the yen to get stronger. They just keep getting stronger and stronger and stronger. The pound is the thing that's getting ripped apart from, here's the Brexit effect here. But they were going down anyway. They just continue to pattern after this Brexit thing. Canada is even recovered. So, but basically what you see here, this is just everybody's manipulating their currency. Here's where they want their currency, here's where they want their currency, here's where they want their currency. Britain lost control of their currency, and Japan has lost control of their currency. And New Zealand is stronger than they want to be, too. They don't want their currency strong. But New Zealand's like Japan. It's a currency that is disproportionately bought out in Asia. Nobody here would buy New Zealand, whatever, but in Asia, people invest in New Zealand, such a small country that it screws them up as far as trying to keep a lid on their currency. But all these guys who practice a lot of manipulation, we're flat. We're generally flat. I mean, things happen that make us go up and down, but we come back to the peg. That's what they call a currency peg. So what's going to happen if Europe loses control? Though that's a big deal because they're approximately 20% of all currency that's traded. So if the euro starts flipping down and people lose confidence in it, where is the money going to go? It has to go to the dollar. Japan is they don't want it. Japan will do everything they can to stop you from buying yen. They do not want you to buy yen. They want the yen to be weak. So they'll buy dollars. They'll do whatever they have to do. They'll print money and buy dollars. They'll take money right off the printing press and trade it for dollars, or as much as they can until their currency starts coming back down. They do not want this to get broken. This is the 100 line on the yen. They absolutely don't want that to get broken. And it's come very close to the last, all summer long, basically. They're fighting it and fighting it and fighting it. So it's going to be interesting, I'll tell you that much. This could still, okay, so hopefully Pat's back. This could still wind up a down day. Really? I don't think so. That would be catastrophic if it is. No. It's being, we're pinning in here. I mean, whatever the reason, this is where we're trying to. This is our goal apparently. We're trying to hit these levels. We're hitting the levels. We're holding the lines, and we'll just have to see what happens. Don't forget China's closed, so nobody wants to have you don't want China to wait to come back to a bad week because they'll freak out. All right, last couple of questions. We got to go. The Fed has been trying to engage in asset inflation without affecting money velocity to avoid inflationary pressure. Yeah, that's what they're doing a good job because giving money to rich people doesn't do anything to increase the velocity. It also does nothing to improve the economy. So what's the actual point? Asset inflation does not help the actual people who live in this country. So they don't hold much of the assets. People in the bottom 90% hold very, very little of the assets, of the equity assets, anyway, bonds and things. Can we look at the OOP? Okay, final request, that's what we'll do. We'll take a quick look at the portfolios. Dun, 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 dun. Next week is the expiration week, is it? Wait. Let's say the 5th. Where's that thing? I don't like the new calendar. No. Options don't expire till the 21st, but I guess we'll go with the portfolios anyway sometime between, maybe on the week, I don't know, maybe on the weekend or before the weekend. We'll see what happens. So here's the options opportunity portfolio. Bum, 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 bum. In good shape, it's up 111%. And we have SJB, which is not working out. We have, that's junk bond shorts. We have the USO play, which I haven't made the adjustment yet, but that needs to be adjusted. We have the Barrick Gold. Nothing wrong with that. We'd love to own Barrick for $12. We don't care that it's been going down. BHI, total faith in that one. FCX, we like them. We'd love to own them for less than $5. Target, we'd love to own them for less than $60, not a problem. And WSM is below 60, but we sold these puts for $11, so we're fine. We're basically on track on those. Then these are our hedges. FQQ and TZA are our hedges. Obviously, both doing badly. But look at the loss. We lost $500 on that one, and we've lost $3,000 on this one. So call it $4,000. So it's cost us $4,000 since August 5th to have these hedges in place. So we're protecting $200,000. We're protecting $211,000. What do you think it costs to protect $211,000? So at the moment, it's costing us $4,000 a month. So our job is to make more than $4,000 a month with our $200,000. Okay, since 5% of $2,000 is $10,000 a month, So we have to make, if we can make 5% a month and offset it with this, we're in good shape. That's essentially what we're doing. We're trying to lock in our gains. It's tempting to liquidate everything because I don't trust the market, but if we're going to stay in the market and stay invested, then we're going to keep maintaining some of these good hedges. But here we are. It's a good, it's not 1 month, I'm sorry, it's 2 months. So it costs us $4,000. It's October 5th, it's not September 5th. In 2 months, it's cost us $4,000 to maintain these hedges. I'm perfectly comfortable with that. $2,000 a month is essentially 1% a month is the cost of insuring the portfolio. And that's fine for an aggressive portfolio. If you had a little dividend portfolio, it would be too much. But if you had a dividend portfolio, it would be full of much safer stocks that are less likely to drop. These stocks are volatile, and in a really down market, they'll take a big hit. So we need good insurance. But also, these stocks throw off a lot more than 12% 12% annual profit. I mean, obviously, because we made 111% since last August. Not 2 months ago, and whatever, 14 months. So we're averaging 10% a month. These are aggressive positions, so they need aggressive hedges. TLT back on track. We only predicted 133, and we're at 134. So totally back on track on that position. Apple, Baker Hughes, DBA we just talked about. Disney we just talked about. GoGo is well on the way. Hovnadian, disappointing, but we don't mind. IMAX, as I said, we like them. Coffee Joe is another good one that we picked. Kate, we talked about. That was from our buy list, our watch list, I mean. Leibu, our favorite. Weren't we supposed to buy another round of these? What happened? Oh, I know what happened. Yes, we are. We're supposed to do another round of these, but the March calls weren't being traded yet, so we were waiting. But we definitely want these again. We always want these. This is the best. Although now it's, it kind of got away, though. We love Leibu. That's an Ultra Biotech Long. Yeah. See, when I wanted them, was back here, and we wanted them at 50. I'm not so excited. I still think they're good, but we'll see what the prices come out to. That's a shame. Lumber Liquidators, obviously, we love them. Marvel, like these guys too. SGYP, that's a new one. We just picked that one, and they're moving up nicely actually. SunPower, recovery play. We hope they'll pull it off. Taser, we just talked about Taser. Twitter, Twitter was a loser for so long. Now it's like $24. We only expected 18, so we're miles in the money. UNG, trade of the year. Not worried about a trade of the year. And Exxon, we were still hoping would do better. It's not bad. It's back to 29, but it's not gangbusters. But that's fine. I mean, we don't mind the way it's going. We already cashed out part of it, so we already took money off the table. We just left this part, and this part's even at the moment. So if we're lucky, it'll do better. If we're not lucky, it won't do better. It's not a big deal, but it's kind of a gamble. So there is the 5%, the option opportunity portfolio. Butterfly portfolio, 190. And, yes, 190, perfect. All right, the Butterfly portfolio, right on track. Long-term portfolio is still 125, I guess. Also on track. And the short-term is hopefully not lose. Now, the trick for the short-term is, did it lose more than the long-term gain? No, it did not. We're still at 370. So we're still in good shape. We were at 380 like a few weeks ago. Now we're at 370, so that's $10,000 lost. The $10,000 lost compared to about $30,000 gained in the long-term portfolio. So that's a perfectly reasonable trade-off because these are the hedges for the long-term portfolio for the most part. So that's it. I think the portfolios are in very good shape, and there's no reason to change it. We're just, look, it's not exciting. It's very boring at this time of year because we don't want to make any aggressive moves, so we're kind of drifting along and collecting our premiums. But I think I mentioned, in the last review, the 5% portfolio, the options opportunity portfolio, is on track to make another $100,000 over the course of the next year, just by not touching anything. So why would I touch anything? Those positions, as they stand, are good for $100,000. Our goal is only to make $60,000, so we're way over target. If we see something really good, we add it, like we did just add SGYP. So if we do see something new, we're going to add it, but we're not going crazy because we have the positions we have. And we're not sure about the market, so we're just staying cautious, mostly on the sideline, plenty of cash, and we'll take advantage of opportunities when they come. Can we look at the OOP? Should we close out the ADX puts? Do you mean in the OOP? That's not the OOP. These guys? No. There's 2018 $12 puts. We sold them for $2.20. So our net entry on this is $9.80. And we would get 500 shares of ABX at $9.20 if it's assigned to us. So I'm either going to keep my $1,000 or I'm going to get ABX at $9.20. I'm going to get 500 shares of ABX at $9.20. I would rather get the ABX at $9.20. So the $1,000 I can make anytime. But getting 1,000 shares of ABX for $9 a share, that's something special. So I would be more excited if ABX goes lower and I have a reason to buy the ABX for that kind of price. That would make me happier than getting $1,000. So that's my answer to that. No. Why would I close it when it's my dream is to get that, is for that thing to be put to me. I wish it will start losing money so I have a good chance to buy ABX for that kind of price. And honestly, it takes years of practice and experience. It's easy for me to say that should be your attitude, but you won't understand it until you do it. You won't understand it until 3 years from now, 5 years from now, you're sitting in your portfolio, you're looking at your portfolio, and you're looking at your ABX position, and you're saying, oh yeah, there was that time that I sold those puts, and it got assigned to me, and I doubled down, and I ended up with 1,000 shares of ABX for like $8, and now it's 15 again. And now I have an $8,000 profit in 3 years, 100% profit, on a position I thought I was only going to get $1,000 on. That takes years for this thing to play out. But until that happens to you several times, you won't really understand what I'm saying. But what I'm trying to explain to you, I would rather lose money on that put and have ABX assigned to me for $10.80, for $9.80 net. That would make me happier than if I make $1,000 on ABX. And I know that's, that's what I'm trying to say to you. It's hard to understand why until you go through it a few times and realize that I'm looking at like an $8,000 upside in 3 years versus getting a quick $1,000. Because either way, I value ABX at about $15. And whether the market sees it or doesn't at any particular time makes no difference to me. Because I'm patient. And I'm patient when I'm buying, because I'm not interested in buying any ABX unless it's down around $10. But meanwhile, if I can promise to buy ABX and some sucker will give me $1,000 to promise to do something I'm dying to do anyway, then why wouldn't I? Okay, like you have you drive a let's say you have a Toyota Camry and it's a $30,000 car. And I'm like, well, I'd like a Camry, but I'd like to buy a Camry for $20,000. And you're like, well, they don't cost $20, they cost $30. And I'm like, I tell you what, let's say the Camry goes below $20,000. Okay, I promise to buy it from you for $20,000. Now, if whoever was asking about the collar before, this is what a collar is, right? If you were worried that the car would go below $20,000 in value, then you'd say to me, okay, I'll pay you $1,000 for you to promise to buy it from me for $20,000. And I'm like, yeah, sure. Where's my downside? I'm going to get $1,000 right now because I'm promising to buy a $30,000 car for $20,000. So there's only two possible things that can happen. I'm either going to keep the $1,000 for doing nothing, or I'm going to end up getting a Camry for $20,000. Those are the two possible things that can happen to me. I'm perfectly fine with either outcome. In fact, and on the whole, I would rather buy the Camry for $20,000. That would make me happier than getting $1,000. That's what this is. If you know the value of what you're buying, if you understand how much things you're buying are worth, where you know better than these idiots on TV, you know better than these schmucks you read in the paper, all these 1,000 analysts on Seeking Alpha or Motley Fool or whatever, you realize they don't know what they're talking about. They really don't. They're just guessing. You have to understand what things are worth. And if you understand what things are worth, then you don't mind owning them. And if you don't mind owning them, you have a lot of power. So my power here is I know for a fact I want to own ABX for $9.80. And I will not get shaken out of my position. I will not panic. I will not sell a put. And in fact, frankly, I will sell more puts if it goes lower. Because I don't care what the price of gold is, I still want ABX for that price. I still want to own the miner that mines the gold. So I'm not buying gold, I'm buying a mining operation. They own a lot of gold, but that gold is certainly not reflected in the price of the mining operation because ABX's total market cap is maybe $12 billion, and they have 100 million ounces of gold, which is $120 billion worth of gold. So they're being valued at 1/10 of their gold holdings. So they're not. You're getting zero. They're getting zero value for the gold. They're getting valued as a miner that makes a certain amount of profit per year mining gold, not being valued at all for the assets of gold they do own. Now, of course, the gold's only worth the extraction. The net cost of pulling it out of the ground, less less from the cost, less from what they're going to sell the gold for, is not worth the whole $120 billion. But if gold does go up to $1,500 an ounce, they get some incredible leverage. And so that's, ABX is the example there, but it goes to any company. It goes to Baker Hughes with oil. It goes to Freeport with copper. It goes to Target with selling merchandise. It goes to Williams-Sonoma with selling overpriced cappuccino machines. Whatever it is your company does, you have to have a firm value that you place on this. And you have to say, I know what this company's worth through thick and thin. No matter what the economy is doing, I know that they'll survive it. They'll get through it. They may go to a certain price. Just like in 2008, a lot of people went to crazy prices. That wasn't what they were worth. It's just what they were priced at the time. The value is a whole different concept. And if you don't understand the value, then when things get low, you won't be the buyer you should be. So, if you're going to make a change in your trading habits, that's the change you've got to make, is understand more about what you're buying. And the best way to do that, by the way, if you're not an experienced trader, is take a specialty. Start with the sector that you enjoy reading about and read about it all day and all night and learn everything you can about it and then play that sector. And you'll start learning where the values are. Don't flip from stock to stock to stock. Don't use screeners and pick the best this and the best that. Because if you don't understand the business, there's no point. Work with businesses that you understand the value of and you understand how they work, so that when you hear the news, you say, oh, that's good for this company or that's good for that company. And I don't mean vague crap like, oh, the price of gold affects ABX. That's not really it. Because there's a lot of things that affect ABX. Like what political party is in charge in Bolivia affects ABX. Things like that affect ABX. There's a lot more to it. Labor laws, strikes, environmental concerns, weather. There's all these factors that affect ABX. But, you could learn the gold industry and pay attention. Then you understand the dynamics, the relationship, and obviously the price of gold is a major factor, but then you've got to start worrying about currencies. So even when you decide to specialize in one thing, you end up learning about a lot of other things just to work on your specialty. And it might take a couple of years, but once you have one specialty sector down, you will be ready to branch out to the next one. And the more sectors you have, eventually you end up like me. I know I know a decent amount of stuff about so many things that I start understanding all the little connections between the sectors. And that's when you can get really effective at picking things. But to start with, specialize. When I started out, I only played tech. My father was a systems analyst. I was into computers. I played tech when I got out of college. It's all I played. I couldn't give a crap about a food company. You couldn't, my broker would talk to you blue in the face and say, what about this and what about that? I don't care. I only care about tech. I want computer companies. I like Intel. I like Microsoft. I like Cray Computers at the time. I like Sun I was investing in. Apple, of course, when it came along. I liked computer companies. If I saw a cool computer company, I invested in it. And then I would watch it, and I would pay attention to see how it goes. Now, liking computer companies ended up getting me interested in the dot-com companies, in the web companies when they came along. And the web companies got me into the telco companies. And the telco companies got me into the retail companies. The retail companies got me into the shipping companies. That's how my knowledge grew over time. But you can't understand the retail companies unless you understand the tech companies that are making the stuff that they're selling, and then the clothing companies that make the stuff they're selling, and so on and so forth. You have to have a depth of knowledge of what you're doing, and to do that, you've got to concentrate on something. You can't flip all over the place. So when you're starting out, specializing is very good. Over time, you will learn more and more things, and you'll diversify more. But when you're starting out, don't try to know everything about everything. It's crazy. You have to learn something really well to have proper values on it. And then you would never have to ask, should we sell ABS at 15 when our net price is 10.80? Like, why? Why would I not want to buy ABS for 10.80? There's no possible way I don't want to buy it. So it's not even a question that would cross my mind because I have a value assigned to me for ABS. And that goes for all, in the long-term portfolio, probably a dozen companies at least that we've done this with. 20. It's 20. So, look at Cliff. so Cliff we like so much we did it twice. But yeah, of course I want to buy Boeing at 90. Of course I want to buy Sotheby's at 35. I want to buy Cliff at 5 or 4. I want to buy Duncan at 45. I want to buy Encana at 7. I want to buy Freeport at 8. I want to buy, these are my things. We got paid for all these. Do you know how much money I got paid to promise to buy this crap on sale? $10,000, $15,000, $25,000, $35,000, 40, 45, 50, 55, 60, 70, 80, 90, about $100,000. So, in the long-term portfolio, in exchange for promising to buy, and these are all 218s, we have one 219, but over the next year, essentially, we're getting paid $100,000 for promising to buy these 20 stocks on sale. And we do this all the time in the long-term portfolio. Every month, we collect another our goal is $4,000 or $5,000 per month that we collect in exchange for our promising to buy something. Every month we do this. We find a stock once a month and we do it. And you know why we do that? Because every month then, effectively, it rolls over on us. So we have a nice steady income coming in the long-term portfolio for only on this one strategy, buying stock, promising to buy stocks cheap. Every stock. GoGo is 11. I promised to buy it for 10. IMAX is 29. We promised to buy it for 28. Now, don't forget, 28 less what we sold the put for, but that's beside the point. Infineon is 950. We promised to buy it for 8. Intel is 38. We promised to buy it for 25. Monsanto 102. We promised to buy it for 100. Schnitzer Steel 21. We promised to buy it for 13. Skechers 23. We promised to buy it for 25. Well, that's an aggressive one. But we got paid $5 to promise to buy it for 25, so our net is 20. Silver Wheat, that's a really old one. SunPower is low. We actually are losing on that one at the moment. Teva also is flat, but it's 45. We promised to buy it for 45. Target is 68. We promised to buy it for 67.50. So you get the idea. This is how we collect $100,000. We get the cash up front, and we're promising to buy these stocks if they get cheap. And that's how we make our money. $100,000, by the way, is 20% of our original $500,000 investment. So we're getting essentially 20% of our total portfolio value, what we started with, in 1 year, just for promising to buy things cheaply. Best strategy on the market, by far. All right, that's a good place to end it, and we'll do it again next week. All right, thanks for coming, everybody.